Scott Zambelli here with Keller Williams Realty Lakeside in Shelby Township, Michigan. And today I'm joined by Dan Paradowski of Movement Mortgage from the lovely downtown Rochester area. How you doing?
Wonderful. How are you today?
I'm doing awesome. So great to have you here with me on my real estate website here in the video. So thank you for coming on board.
My pleasure.
Thank you. And today what we wanted to talk about with all you guys is for people who are looking to buy a home, you know, what is the mortgage process? What's the importance of a pre-approval? What is a credit score, and how are those magical numbers? Where do they come from? So you know, Dan being our in-house expert here, well, formerly in-house, now you moved on to lovely Rochester, which is awesome.
Next door neighbor.
Yeah, so now you're a neighbor, like the Mr. Rogers neighborhood, and So first of all, let's start off with who are you? What's your experience in mortgages, and you know, what's your background there? How long have you been doing mortgages?
Well, sure. Thanks so much, Scott, for having me on.
Yeah.
I've been causing trouble in the mortgage world for the last 5.5 years now. I started under the company Mortgages101 Incorporated, and I've transitioned to a new company called Movement Mortgage. They're new to the Midwest. I'm probably the 21st loan officer in the company here in Michigan, and they're closing loans pretty fast, so I'm excited to be on board.
Yeah, now, Movement Mortgage, they're a pretty established company out east. Is that correct?
Yeah, they do a little over $10 billion in origination, and they were modeled after the Keller Williams template to work with agents, wonderful folks like yourself.
Yeah, the founders actually were from Keller Williams originally. Is that correct?
They were friends with Gary Keller.
Great.
Yeah.
And Gary Keller, for those who don't know, is one of the founders of Keller Williams.
Absolutely.
So, yeah, great. And you've gone over to Movement Mortgage, and I know you've been going through some amazing training over there.
Sure, lots of training, flying around the country.
Yeah, you were in Virginia.
Yep, Virginia Beach.
Yeah,
yep.
and then all of a sudden I saw you were over in L.A.
Los Angeles.
You're just jet setting it, living the rock star life, right?
Trying to keep up with Mr. Paris here.
Yeah. Oh yeah. But yeah, and from seeing your posts. You're going through this amazing training that's, you know, even with 5.5 years in mortgages, there's always something new to learn, new processes in place, and so how has that growing period been for you during these last month now, 3 weeks?
Yeah. Well, it's been really great, and of course they've kind of changed the process as far as the definition of pre-qualification versus pre-approval in the market today. So it's great that you touched base on that at the beginning, because it's definitely a topic we want to talk about today.
Yeah, so let's dive right into that, because when a buyer comes to us as a real estate agent, you know, one of the first things we want to ask them is, are you pre-approved?
Right.
And why that is so critical is because when we go in with an offer, the other agent wants to know, is this a serious offer? And that pre-approval letter tells us that they've talked to a mortgage person, and the pre-approval is actually the more thorough of the two between that and pre-qualified, correct?
Well, nowadays the definition for pre-approval means that a physical human underwriter has actually seen the file, which is a really rare case with most companies, and was one of the reasons why I came over to Movement.
Okay, so pre-qualified would be, for example, when they do those quick online, they log in and they get a quick pre-approval. They haven't talked to a physical human. So that's a pre-qualification?
Well, there's a couple levels of that.
Okay.
One would be some type of online application where you may or may not even speak with somebody. The second would be a phone conversation where you're running credit and verbally discussing numbers. Also, pre-qualification has that umbrella in which you may even sit down with a loan officer, bring in your physical documents, which is really important to do as part of the pre-approval process. But you can get a lot of the hurdles out of the way with that pre-qualification process, just by sitting down with an originator, a loan officer up front, and bringing some of those key items that'll help us know if they're ready to go.
Nice. Now you do bring up hurdles. So when a potential buyer is in this early stage, what are some of the most common hurdles that you seem to come across that maybe if a buyer knew this up front could be avoided?
Sure. Well, we're really looking at 3 different categories when we're pre-qualifying or pre-approving buyers, and that would include credit, income, and assets. We call it the CIA of mortgage lending. So we're going to take a peek at those 3 areas to see if there's any help needed to prepare them for the home buying process.
Great. And so let's hit each of those individually really quick. So income was the,
You're going to see what type of income. Is it self-employed? Is it a W-2, salaried, hourly? We're going to look for deductions on pay stubs. Sometimes people have certain deductions on there, be it child support or otherwise. And then we're also looking to see if their year-to-date income matches what they're putting down on the application, all sorts of things. Sometimes we even have to do a verification of employment where we send an actual fax over to the employer to double-check overtime and different things like that. Most people don't know, for example, that you can only use overtime if you've had a job at the same location for at least 2 years.
Right, and that's key for, like, I know a lot of people in manufacturing, for instance, they'll have a lot of overtime, but they might have had multiple jobs over the years, and they may not have that 2 years. And so on paper, like with overtime, they might have made a very substantial income, but when you back out that overtime, they're not, they don't qualify for that level that they thought they were going to.
Exactly. So it's good to take a look at that information up front so we can make sure that you're not getting in over your head when you're out there shopping with Scott.
Right. And then also, this day and age too, the more traditional income is, the W-2, the typical job that someone will get. But self-employment is a big part of today's culture. Self-employment is greater than ever, as far as I understand it. So if somebody is self-employed, what kind of obstacles are there? What do they need to bring to the table to prove what they actually are earning?
Well, generally, Scott, we're looking for at least 1 full year of work on the job. So that would mean an entire 12 months being recorded on a tax return.
And that's the key, on the tax return, because some people like to make money on the side in cash, but if it's not being reported on taxes, it doesn't count.
Thanks for playing. Please try again.
Exactly, and that is such a key issue because you can only approve based on what is legally reported, and because that's ultimately your tax return is that. So one of the things is if you're thinking about buying a house in the next year or two, and you are earning income in a high cash business, you want to make sure you're reporting that if you're going to want to get a mortgage based on that income.
Absolutely. Yep.
Not that we're encouraging anyone not to report stuff. Definitely report it.
Good job.
Yeah, definitely. A little disclaimer. We got asterisk. But so that was the income side. What else did we? Assets and credit.
Yes, correct. So assets, we're looking for money to be in an account for at least 2 months. It's called seasoning, or 60 days of time. So you might get folks who have money in a safe at home or in a mattress, and it's great to sit down again for that pre-qual, pre-approval, because you're going to get that excellent advice which says get the money in the bank ASAP.
Right, and the reason for that is they don't want they don't want somebody supplying the money on your behalf and you taking claim of this money that you never really did earn.
Right, you got to have a paper trail on it, so we're looking for direct deposits from work. We're looking for tax refunds showing up on a bank statement. Anything that can be documented with a paper trail. Sometimes we'll get copies of checks for self-employed borrowers. So there's a few different things we may ask for depending on what type of income you have.
Right, and also this also goes in reverse too, right? Where you might have that money in the bank for the pre-qualification, and then maybe they get excited about the new house, so they go out and buy a large furniture purchase,
right,
and deplete those funds because they think, oh, I don't need those funds in there now because it was already approved. Well, when it's time to close, you're going to be double checking all that, correct?
Yeah, I mean, they may take their realtor out for a really nice 4-star dinner, which is very important, either before or
after the closing.
After the closing. But yeah, definitely people get excited. So
yeah, you got to be careful on. You don't want to do any crazy changes from when you get that pre-qualification to when an offer is made to when the closing occurs, because that's a delicate time that can make all the difference in what happens at closing, and if the closing happens.
Yeah, the main area we run into bumps with that often is the third category, which is the credit.
Credit.
Where sometimes people will buy a sweater online and they open up a new credit account,
Yep.
or the lease on their vehicle may renew.
Mm-hmm.
So
Yeah.
there's areas where people are incurring new debts during the mortgage process.
Right.
Well, those have to be part of the overall financial picture, and we have to get those added to the credit report
Right.
cosmetically.
Now, talking about the credit report, one of those things that are very mystical and mysterious to all of us regular folks outside of the mortgage side, where does this number come from? What is a credit score?
Well, that is a great question.
Or do you even know? Is it Gandalf out there doing some conjuring?
Oh,
or-
no. Credit score is not Lord of the Rings.
Okay.
It is definitely a measurement of a person's ability to stay in debt, maintain debt, get new debt, pay your debt on time, and have a variety of debt. So
Right.
it's really a measurement of a person's ability to stay in debt, which sounds kind of negative when you put
Right.
it that way, but I often like to frame things in that mode when sitting down so people really understand what they're getting into.
Right.
Okay, so there are 5 main categories that we look at on a credit report that factor into your score.
Okay.
And they were those categories I briefly mentioned, such as how long have you had credit, what types of debt, you may have a student loan, credit card, what's the balance on those items in comparison to the limit. Okay, if the balance gets too high, the score goes down. Okay, if the balance gets all the way to 0, well, you may not get as many points as you would if you carry a small balance. So there's little tricks to watch out for, but those 5 areas, length of credit history, types of credit, the credit utilization, how much you're using compared to the limits, and do you have a variety of debt, and are you paying that debt on time?
Now, and correct me if I'm wrong. Now, when you're reviewing all this, some things you can do to improve that credit health is like you might have let's say you have 15 credit cards open that you've done through the years, but you've never closed any of them. You might have an old department store credit card or whatever. Closing those out, that helps you out too, doesn't it? Because you have because even though you're not using it, that's potential debt you could access at any time, right? So you would want to close those unused accounts out, is that correct?
Generally, I tell people not to close
okay.
or open any accounts during the
Well,
mortgage
not
process.
during, but I mean, like if somebody was thinking about buying maybe 6 months down the road or something, would that be a good thing to do, is get rid of those things or not?
Well, it depends, because one of the 5 factors is length of credit history. So if that borrower has a store card that's 20 years old,
Oh, it might help them actually.
it might help them.
Okay.
Another factor is, are those items active? If a card hasn't been used at least twice a year, then it goes dormant. It becomes
Oh,
inactive
okay.
every 6 months. So it might be as simple as activating a card. Sometimes we add people as an authorized user to a friend or parent's account. That may give them an instant boost.
Oh, interesting. Okay.
Other times we would just pay down credit card debt. A lot of times that will greatly influence a person's
Great.
score. For example, I had a borrower that had, say, a $300 charge card with Sears.
Okay.
This was his only credit card, and he had a $305 balance. Everything was paid on time, but because that balance was so high, in fact, a little bit above the limit, which you see now and then, it really drove his score down. So as soon as he paid that down to $10, $20, $30, he actually got about 97 points on his
Oh,
credit score.
wow.
And that reflected the very next month, and he went out and got a house. So it's
Wow.
just another...
Isn't that amazing? So this is a $300 balance, 305 balance that we're talking about, that completely changed whether or not he could get a house.
Right.
So, and this is why it's so important when you come in, when you're going into the process of looking to buy a house, talk to a mortgage person like Dan as soon as possible, because they can sit with, even if you're not ready now and you're thinking 6 months or whatever down the road, they can advise you onto those type of maneuvers that will help you out and maximize what you can do in getting that home of your dreams.
Yeah, a lot of people think that by paying your credit cards off every month, that's going to be a good thing. Well, the truth is the rules for credit have changed a little bit in the last year, and so you do have a greater chance of getting an approval in the computer system that lenders use if you're paying your accounts off every month. But if you're trying to improve your score, increase your score by carrying a small balance and paying that interest charge, oh, you bet the people that give you a credit score, they like when they get an interest payment.
Because that's how they make money.
Right. So even by carrying $10 on an account,
Wow.
you're going to get way more points in your credit
Yeah.
score, and it could really
Yeah.
make the difference between a whole point or quarter of a percent as far as interest rate. It could save you a lot of money over the years.
And even going on a completely opposite extreme, I have a friend who you're familiar with. He's lived his life completely debt-free.
Oh, right.
And he's been very responsible, but the problem when you do that, and it seems so counterintuitive, it's like, okay, I'm living a perfectly debt-free life, no debts, everything's paid in cash.
That's the way to do it.
Right, but except then you go for a loan and you have a 0 score, right? It doesn't even exist, your score.
Right, right.
Yeah, so you don't even exist. You're a ghost, and so when somebody lives their lifestyle like that, what is the process for them to become a viable part of the credit score game so that they can apply for a mortgage?
Okay, well, your best bet, if you have enough time, at least a few months,
Right.
would be to add yourself as an authorized user to someone's account, usually a family member, sometimes a friend. And although you may not use that card in particular, you will get the benefits from that.
Okay.
And then shortly thereafter, once you have a score that's registering, you can apply for your own card. And I'd recommend a secured credit card.
Right. So even like for someone like myself, my daughter, she's 18, for instance. So if
Mhm.
I wanted to help her build up her credit score, I could add her as an authorized user, and that would help her?
Yep. You could even give her a copy of that card to use in emergencies, as
Right.
long as she understands you can't go crazy with this thing. You got to pay
Come
it back.
home to 400 pairs of shoes. No.
We do get clients now and then that they get that piece of plastic and they
Oh, yeah.
think it's a free ride at Disney World,
Right.
and they're still in Shelby Township, you know.
Exactly. They didn't even get the benefit of Disney World.
Slow down, James Brown.
Yeah, indeed. So, well, that's good to know. Any other bits of advice for people who are trying to create a credit history? We just talked about the credit card part. Also, an important part is establishing like a history of payments on time. So, like, how long was it for like having like if they were paying rent or something?
Right. Well, obviously, if you have some type of housing expense, like you're renting, then that's going to look very similar to getting a house. So
Right.
if you don't have any debt, no credit score, but you have a 12-month rental history, that can really help.
Now, would that have to be an official rental history where you have an official lease and you're
Yep.
paying in checks or something so that there's a paper trail?
Exactly.
So if they were once again paying in cash, would that would be a problem, right?
Not gonna
Because you
help
wouldn't
you
have
out.
the history. So you want to write them as checks. So at the very least, you're creating a paper trail, and you have a mortgage or a lease agreement
Yep.
that shows that you have these terms set up that you have met your obligation to.
On time every month. You
Right.
got it.
Okay, that's good to know. Let's see. I think we covered everything in that area.
Yeah.
Okay.
Yeah. Those are the three basic areas that we look at as far as credit goes. Credit, income, and assets for the basic pre-qualification.
Great.
I don't know if you want to talk a little bit about some of the documents that we normally use.
Yeah. Fill us in on that. What is the normal documents you use?
Funny you should ask. I like to call it the Fab Four.
Okay.
It's your tax returns,
Mm-hmm.
W-2s, 1099s, same thing. Third category would be pay stubs. Fourth category would be bank statements.
Okay.
So we're usually getting 2 years of taxes, 2 years of W-2s, 1099s, 1 month of pay stubs, 2 months of bank statements. That's the Fab Four in terms of
Okay.
category.
Yeah. So definitely you want to keep track of all that when you're getting ready to go in. Another thing also with credit scores that especially with what occurred about 10 years ago or so, bankruptcies. Those can appear on people's backgrounds. What are the rules there if you do have a bankruptcy or a foreclosure in your credit history there? What are the rules before you can come back and get a mortgage?
Good question. There's a couple different types of bankruptcies. There's a couple different timelines that you're looking at. It also depends what type of loan you're getting. If you're a veteran and you're getting a VA loan, the timelines are a little bit different.
Okay.
But generally speaking, your at about a 3-year wait on average.
And that's if there was a house involved with the bankruptcy. Is that correct? 3
Well,
years?
it's whether you have a bankruptcy or a foreclosure
Okay.
or both.
Or both. Okay.
So let's say, for example, you lose a house to foreclosure and you file bankruptcy to protect yourself from any extra debt that you may owe
Mhm.
after the bank or the county sells that house at a sheriff's sale.
Mhm.
Well, it's a 3-year timeline from whichever happens last. So bankruptcy date, you're going to have a discharge date. You'll get a little discharge paper. Sheriff's sale or a short sale, you're going to have a document from that as well. So whichever date is later, then
The
you're
3 years is
yeah,
from there.
exactly.
Okay, that's good to know.
That's for FHA. If you want to go conventional, the wait's a little bit longer. A bankruptcy by itself is 4 years, and if there is a house involved that went to foreclosure or short sale, then it's 7 years.
Okay, good to know. So there you have it. Because unfortunately, we had some rough times there, especially in Michigan, where
Yeah.
there were a large number of bankruptcies. So, and we're still in that time frame where they still have, some people have done it more recent enough that it's still on there and can
Mhm.
affect their ability to get that loan. So, so once we go through this process and we've done the pre-approval and we've made the offer and the offer is accepted, what's next? What the ball now is handed to you. Where do you run with it? What do you do as a mortgage rep there?
Well, we're trying to get all the way to the goal line there.
Yep.
And
And that's the goal line being the closing.
yeah,
That's-
generally, if the client gets us documentation up front, at our particular company, we've already submitted the loan, we've already gotten it approved, and we've already cleared all the conditions. So all we're really waiting for at that point is an appraisal and title work.
Okay. Now you mentioned you submitted a loan. That's now becomes the underwriting process, right? That you're submitting it to underwriters.
Yep.
And that's like a dark secret society that none of us get to see, right? They're like, who knows who they are? I don't know.
Yeah, yeah, they all wear weird looking masks and
Yeah.
travel in packs.
It's like I don't think anyone ever actually meets an underwriter.
Nope, they all have code names.
That's the true CIA in the whole abbreviation you gave earlier. But so the underwriters actually review it, and they're the ones that decide the final thing. So because sometimes that's important to know because, you're the face of the mortgage. You're who the buyer is dealing with, but it's not necessarily you denying them. So people.
Oh no, if that
Right.
were to occur, no.
Right, but sometimes they can take it personal and they think it is actually you doing it, when really there is a whole process behind the scenes and how it's reviewed and it's a third party just making the final decision, correct?
Well, generally, we're looking at the file up front, like you said,
Right.
and we actually take all the documents and we run it through a loan software program that was created by the loan program itself, by Fannie Mae or Freddie Mac.
Right, which are
okay?
government run agencies that handle these things, right? They're both government?
They are not.
Oh,
Those are
what do
actually
I know?
those are actually Wall Street.
I'm just
entities.
testing 'em.
Right, right. You've got FHA, which is a Federal Housing Administration. That's a government
That's
type
government.
loan. You've got Rural Development or USDA, United States Department of Agriculture. Who knew farmers were involved in helping us to get houses,
Yep.
but populating those more rural areas.
Yep.
And you got your VA loans as well. So each of those programs have different computer software that
Got
we
it.
run all of those documents, the FAB4, the credit report, the application. And if we can get a green light through that, then there's about a 99% chance that you're getting to the finish line.
Nice.
If people change jobs, go on vacation, take on new debts during the loan process, that can sometimes throw a stick in the wheel.
Right, so when you're in this process, don't do anything.
Right. It's, stable Mabel is kind of
Yes.
the key phrase. Steady as we go.
Yeah, right,
Right.
exactly.
So if we can get that green light through our automated software up front, then there's a almost 100% chance that underwriter's gonna
Awesome.
sign off on that loan.
All right, cool. And then when you get that sign off, it comes back to you. You're able to let the buyer know that's when you get the clear to close.
Well,
right?
we have system updates. Usually what will happen is the underwriter will review all the documents either before you go house shopping with us, sometimes after you find a house with other companies, And they're going to look at all those things and they're going to say, hey, great, love these bank statements, but there was this little thing on there, I didn't quite know what that was. Can you explain that? So sometimes people will write a short little letter explaining something. And it's the underwriter's chance to say, hey, file looks great, but could you get us a little bit more information? And those are called conditions, okay? A lot of times the conditions that you'll have in a file have nothing to do with the borrower. There might be an error on the appraisal. There might be a slight issue with the title work. There might be just a document that's missing that needs signatures or is missing a checked box or something.
Right.
So those all fall under the umbrella of conditions, and that will happen after an underwriter sees that file at whatever point the first time. Then it's up to us to get with you, the borrower, you, the client, and address what those conditions are, if there's any we need help with. And then over the next couple days, you'll gather those extra items, and we'll be able to resubmit the file to underwriting.
Great. Awesome. Okay, and then we go to the closing, right?
Hopefully after that, we would get a clear to close.
Yep.
We'd have an appraisal that's come back and title work. There's no issues with the title. And then we would get what's called the clear to close. And we have a 3-day rule where you have to sign your pretty much final draft closing paper so you know what you're getting into. Then we have a 3-day rule called TRID, which we don't have to necessarily get into, but just know there's a 3-day rule between when you get a clear to close and when you're allowed to go to the closing table, just to give the borrower enough time to really assess what the numbers are, have time to get money together if they're bringing closing costs to the table, things like that.
All right, great. Let's see. So at the closing process, that usually, as long typically everything goes smoothly by that point. Sometimes you can have issues, but it's more rare than not. But at that point, you're bringing to the table some money, and the money's going to go to, let's see, you're going to be bringing a check that will end up going to
the title company.
The title company.
Yep,
and the title company then will split it out between the seller and everybody else from there.
Exactly.
Yeah. So, and then you get your keys, and you have a house.
Right.
How awesome is that?
Yep.
And then your home ownership, and you can live life happily ever after.
Right. And you can remember how great Scott was throughout the process.
And how great Dan was.
And you can take him out to dinner.
Well, you can come along.
Or whatever. I'll hold the door.
There you go. But so throughout this process, we've covered quite a bit here. But before we get going, any final tidbits or misinformation out there that you think would benefit them to know that maybe we didn't cover here? Anything?
Sure. The best advice to give is to always keep in mind that you want to have a paper trail with whatever you do, okay? So for example, if you're making deposits, make sure they're not cash deposits. Underwriters are going to question, well, where did that money come from? It creates extra steps. So in that example, hang on to your cash, spend it on gas and groceries, and let your automatic deposits from work add up. Another area is the earnest money deposit, okay? Yep. At the beginning, you can't take cash into a bank and turn it into a cashier's check because the underwriters are going to say, well, where did that cash come from?
Right.
So unless...
Also, another area where cash can magically appear is sometimes there could be a gift from a family member, and you would have to have a letter stating that it's a gift, something that says where that money came from and what it was for.
That's definitely got to have a paper trail too.
Because they don't want this to be a private loan
that
they owe back to somebody.
You can't take out a loan to get a loan.
Yeah, you suddenly show up with 10 grand in cash, they're going to wonder where it came from.
Exactly.
So, and that's where you would need, if a family member gave you that, they'd have to write a gift letter to explain that, no, this was a gift and it's not a loan.
Right, and that can't be cash either. You got to have a personal check from mom or dad. It has to be a blood relative. So creating that paper trail is key throughout the process, and that's the hardest thing for borrowers to understand because they feel, hey, this is my money. It's at home. I'm telling the truth, and sometimes there's a lot of emotion that gets involved because they feel like the underwriters aren't trusting them, and they're just following the guidelines, the rules,
Right. Well, and part of it is they're not trusting you. They're doing their due diligence, and they can't just assume everybody out there is telling the truth because, unfortunately, there are people who do mislead people. So that's why we need a paper trail. We need that documentation too.
Right.
And it's not a personal thing against you. It's just this is the process to protect everybody involved.
Absolutely, absolutely. So that's probably my number one piece of
Alright, great.
advice.
So for anybody watching today here, if they're in need of a mortgage, how do they find you? How do they look you up? How do they call you?
Well, I can have people go to my website. I can send you my link if you want to throw
Yep,
that
yep,
up
we'll
here.
post that up.
But it's basically my first dot last name at movement.com is my email, or www.movement.com/Daniel.Paradowski.
There you go. And I'll have it all
Thanks.
printed up on the screen here so everybody could see that. So, and if you do call them, let them know you saw them on my video here on the Realtor Scott Zambelli site here.
Yeah.
Woo! But I really appreciate you coming on. You've shared a lot of knowledge here, and I really think it'll benefit everybody watching here. So I really appreciate your time and your friendship, and hopefully we can help many people achieve that real estate dream.
Awesome. Appreciate it, and have a great day.
All right. Well, thank you. Once again, I'm Scott Zambelli with Keller Williams Realty Lakeside in Shelby Township, Michigan. And this is my guest, Dan Paradowski with Movement Mortgage out in downtown Rochester. And keep tuning in for future updates here, or go to scottzambelli.com for my website, for my awesome real estate apps you can download. And just stay on my Facebook here for stupid videos that I like to do. So take care, guys. God bless.
Bye.